In this short tutorial, we're going to look at how you calculate the quick ratio from the balance sheet. And we're going to go through the fascinating example of Tesla Motors to illustrate what it means. So let's start by looking at the definition of the quick ratio. So essentially, the quick ratio is answering this question. Does a company have enough liquidity to meet its current obligations without liquidating its inventory? And we can get this from a simple formula. So the quick ratio is the current assets minus the inventory divided by the current liabilities. And so that's giving you a ratio between the current assets you have, neglecting the inventory, divided by your current liabilities. And that gives you an indication of how close or how far a company is from being able to pay off all of its current liabilities by liquidating its current assets. And when we look at this ratio, if you've got it less than 1, that's going to indicate potential problems. So that's suggesting that it's got very weak financial health, though there are some complexities involved. Because if you pay people very late but take in money very quickly, you can survive with quite a low quick ratio. However, if it's greater than 1, that is very suggestive of a company that's in reasonably good financial health. This is an indication. You have to look at other ratios to get a more complete picture of the company, but it gives you a very quick snapshot of what's going on in that business. So let's look at the balance sheet of Tesla Motors, which can be best described as a total car crash. It's an absolute disaster. And so we can extract the 3 parts of our equation. So it's nice and easy. So we've got inventory, it's just one line item on a balance sheet. This is taken from the 10K. Then we've got the total current assets. And then we've also got the total current liabilities. So I've highlighted that. So all you need to do, find the annual report for the company, and you can pick out all of the components of the quick ratio. So let's do the calculation and get a quite shocking result. So we've got the equation. We put those numbers from the previous slide. You may want to rewind if you want to catch those numbers again. And then we put that into a calculator and we get a quick ratio of 0.56. which is suggesting that without relying on the inventory, the company's current assets only cover slightly over half of the current liabilities, which is pretty shockingly bad. So hopefully this video has been helpful to you and you've learned how to calculate the quick ratio. Thank you for watching.